Hello and welcome to this webinar on IFRS 15 with me, Peter Thatcher. Standard on revenue, clearly highly significant as a standard, took many years to develop. As with the more recent standards, it was developed jointly between the International Accounting Standards Board and the US Financial Accounting Standards Board. Took a lot of time and effort over the years, and many changes took place. It's one of these standards where actually we had two exposure drafts before we finally reached the end standard, the complete standard. So IFRS 15 was finally issued in May 2014. So we've had just over 4 years at this point to get ready, get to grips with what the standard requires. You may recall that the initial effective date was for periods commencing 1st of January 2017. This was later changed in 2015, so it was amended to the current effective date, the one we're now working for, the periods commencing on or after the 1st of January 2018. So now is the time that we need to implement it. And for some companies, it's a big year. They've got IFRS 9 to implement and IFRS 15 to implement at the same time. I guess the fact that it's been around for so many years, and you've probably heard people talk about it many times, you've read things about it as time's gone on. So my objective for this webinar is very much about, I hope, confirming what you already know about IFRS 15, rather than introducing any new complexities that you've not yet considered. So I hope it's helping you to get ready for implementation. So what are we going to look at? What's on the agenda for this webinar? What I'm going to do is focus on highlighting the key elements of the standard where things have changed, the guidance has changed, the guidance has been increased compared with the current guidance. So these are the areas we're going to look at, an overview of the recognition and measurement requirements, which essentially are captured in this 5-step model that we're required to adopt. And then some of the key changes, where the guidance has moved, has been added to, applies to a wider range of contracts, and modifications to contracts. Separating contracts into performance obligations has been a particular challenge, particularly for construction industries. Variable consideration requires very careful consideration and development, maybe of models and approaches. The timing of recognizing revenue, which could be over time or at a point in time. The guidance is clearer with regards to that. And then a few additional items of dealing with pre-contract costs, loss-making contracts, then a little bit on presentation and disclosure that emanates from this new standard. Pretty much as always at the moment, whenever a new standard comes out, the disclosure requirements are increased. So we need to look at those very carefully. I'll just give you a flavour of them. But as we always say, the devil's in the detail, and you'll need to go through it very carefully. And then I'll end just by having a quick overview of the transitional arrangements that you need to take account of. So if you have any questions at any time during this hour, please do send them in to me via your consoles, and I will try and answer as many as I can. So just to begin with, in terms of the scope of IFRS 15, the important point that we always make with regards to this is that it applies to all contracts with customers. Therefore, it covers all industries. And some industries are more effective than others, probably. Telecoms is likely to be very affected, construction, software development, but everybody's going to be doing the same thing. That's the key point here. It's also worth bearing in mind that some measurement and recognition requirements also apply to other asset transfers. These are consequential amendments of IFRS 15. So, for example, in IS 16, sale of property, plant and equipment, reference is now made to IFRS 15. So IFRS 15 replaces, important bits it replaces are IS 18 on revenue and IS 11 on construction. So we don't distinguish between types of industry. Outside the scope of this standard, and these scope exclusions are similar to those which are scope exclusions from IS 18, very much focused on financial service businesses, so leasing contracts, insurance contracts, accounting for financial instruments. Some other contracts to do with groups situations are also outside the scope, and certain non-monetary exchanges, examples given where you've got two oil companies exchanging oil without any money changing hands, it's just a swap arrangement, are outside scope. So in that respect, similar to IAS 18, so financial service businesses are less affected by IFRS 15 than perhaps others would be. Just an interesting point, you may have picked up that IAS 18 used to tell us about accounting for interest and dividends. Interest and dividends are now covered by IFRS 9 instead. So where does IFRS 15 change? Well, what IFRS 15 sets is this core principle. It's built around a principle and a 5-step model. So the principle, I don't think many of us can argue with. The purpose is to recognize revenue, to depict the transfer of goods or services, and to recognize an amount that reflects the consideration to which they expect to be entitled. So that sort of makes a lot of sense. The big change is that IFRS 15 introduces this 5-step model that all entities, unless the items are outside the scope, must follow through to evidence the way that they have accounted for the revenue. And so in summary, the 5-step model is this, and we'll explore some of the changes under each of these areas in a short while. So the first thing we have to do is to identify the contract, or identify the contracts. Basically, is there a genuine commercial contract? This is where it deals with modifications and the possibility of combining contracts. So this is done at a high level. What we then do is we have to go deeper into the contracts themselves to identify the performance obligations. And a key change here is that the unit of account under IFRS 15 is at the performance obligation level rather than being at the contract level. So that can present challenges for certain types of business. This was one thing that evolved over time. It was going to be incredibly onerous to begin with, but they revised the guidance to make it less onerous in most cases. So that's at the detailed level. So that might require the allocation of revenue at a micro level. Stage 3 is then we look at the transaction price for the contract. So at a high level, and we take into account things like variable consideration. And then what we do, if we have a number of performance obligations within the contract, we then have to allocate that total transaction price to the individual performance obligations. And the final stage then is to recognize the revenue. We recognize the revenue over time or at a point in time, and there's a very specific process to go through. And we consider over time first, and point in time becomes almost like the default position. Now, what the International Accounting Standards Board have acknowledged is that in many cases, the way that entities recognize revenue and the timing of the recognition will not change because of IFRS 15. And it shouldn't do, because otherwise we were wrong before. However, while there will be some changes, what they recognize is the biggest impact might be is the process of going through to justify the treatment. And that is potentially a challenge for entities in terms of how much evidence might they be required to give to their auditors to justify the treatment they've adopted. So there's a conversation to go on there between those two parties. And if you're an auditor, it's about how much evidence will you require from your clients with regard to the conclusions that they've actually reached. So step 1 is about identifying the contract. So the main part of this is it a genuine commercial contract? And there are criteria that must be satisfied. Broadly speaking, it's commercial, so it's going to make a profit. But basically what you're looking for then, it shouldn't present a challenge, is a contract which clearly sets out the rights and obligations of both parties, the seller and the customer. That contract could be in writing, it could be verbal, it could be implied. But there must be a clearly identified element of rights and obligations being established. So that shouldn't present too much of a problem. The second issue which it highlights is accounting for consideration received when a contract does not exist. Now, this doesn't change what we do, it's what we should have been doing anyway. It just clarifies the guidance. So what it says is you recognize that consideration as a liability until the criteria are basically satisfied, or until you decide the contract isn't going to take place. So in very simple terms, the double entry will be to debit cash and credit a liability. As I say, that's what we should be doing now, and therefore that doesn't change. The guidance is clearer. The next 2 points are more detailed and in some cases new for the types of transaction that you might be involved in. So we have to consider whether we should indeed combine contracts, what we call bundling. And there are criteria that we need to consider in making that decision. And then we also have to consider contract modifications when there's variations to the contract, and consider whether we should account for the modifications as a separate contract or part of the existing one. And I'm going to look at those 2 now, because there are some issues that we do need to think about very carefully. So with regard to combining contracts, so this is the concept of bundling, and this is a requirement when you satisfy the criteria. So as it says there, 2 or more contracts entered into at or near the same time with the same customer or their related parties. So that will sort of make some things clearer, because if you don't sign at the same time, then that would mean combining is not relevant, or near the same time. Might need some criteria to judge that, and then it's the same customer related parties. So you should account for them as a single contract. So what they're saying here is that you look beyond the legal nature of they are individual contracts, and you look at the commercial objectives of the contract as a whole. Now, to help this process, what IFRS 15 says is that when their contracts are entered into at or near the same time with the same customer, if they meet any one of these 3 criteria, then the contract should be combined. So either they're negotiated as a package with a single commercial objective, the amount of consideration payable in one depends on the price or performance of the other, or the goods or service promised are a single performance obligation. Now, those 3 criteria are quite similar to the criteria that were in IAS 11 on construction contracts. The big difference in IAS 11, you had to satisfy all 3. In IFRS 15, you only need to actually satisfy one of these 3. So that's the combining contracts issue, where we might have to consider that. So there might be some issues where you sign contracts at or near the same time to provide evidence that actually they don't need to be combined. The second issue then is with contract modifications. A contract modification is a change in scope or price of a contract that is approved by all parties, and it creates new or changes existing enforceable rights. So this, in the construction industry, has been referred to for years as a variation. You might hear expressions like amendments or change orders. So it's something that's very common in the construction industry, but it could happen in other business. It could happen in consultancy, where the scope of the work is increased, like saying, could you add this to your report, to your investigations, and so on. So when you've got a change in scope or price, the first thing is it approved? Now, this might require some judgment, and it might require some conversations between the auditors and entities in terms of at what point is it actually approved, because it seems to indicate that actually what you need to have is a confirmation that it creates enforceable rights. But if, for example, you have both parties have approved the change in scope, but they're still discussing price, that could still meet the criteria as being a modification, because it creates the enforceable rights. We just haven't quite agreed the final price. So it's not 100% everything's all been agreed. It could be at an earlier stage, and that, of course, could have an impact on timing and therefore an impact on profits and so on. So what IFRS 15 then looks at is whether a modification should be dealt with as a separate contract. And what it puts in place are two criteria, both of which must be satisfied. And if these two criteria are satisfied, then the contract modification should be treated as a separate contract and not combined with the initial one. So the first point is the scope, does the scope increase because of promised goods or services that are distinct? I'm going to come back to explain distinct in a minute or so. The second point is that the price of the contract increases by consideration that reflects the standalone price or the normal selling price adjusted for things like discounts. So both elements need to be in place. So this, for example, might be where an entity sells, let's say, some computers. It's got an agreement to sell 40 computers. They're going to be two tranches, the first tranche of 20, the second tranche of 20, the price has been agreed. The first tranche is delivered, so the first 20 are dealt with, and the second tranche comes, and actually before that second delivery of 20 computers is made, the order is changed and the customer adds another 5 computers to the order. Now, if those 5 computers are added and the price that they charge for the 5 reflects the normal standalone selling price of the computer or reflects any volume discount will be appropriate, those 5 computers are distinct and they reflect the standalone selling price, therefore they would be treated as a separate contract. It then goes on to say, if the modification is not accounted as a separate contract, so if it doesn't meet both of those criteria, then we should account for it either as a termination or as part of the existing contract. So we account for it as a termination and a creation of a new contract if the remaining goods and services are distinct, but it's the pricing that's the issue. So if in that example I gave you where we've got an order for 40 computers, we deliver 20, then before the second 20 are delivered, an order is added for 5, but this time the pricing of the 5, for whatever reason, is at a significant discount to the normal selling price. Therefore, while they're distinct, they don't reflect the normal price. Therefore, we would treat this as a termination of the existing contract and the creation of a new contract. So the new contract would be for the sale of 25 computers at this combined new selling price. The third alternative is that we treat this modification as part of the existing contract if the remaining goods and services are not distinct, form part of a single performance obligation. This is what often happens in the construction industry, where there's slight changes made, but the fundamental construction project is still the same, to build an office or whatever it may be, in which case we use this cumulative catch-up basis. So we simply adjust total revenue and costs, and then we consider to allocate that total over time in the normal way. So there's processes that we need to go through with regards to this accounting. So that's step one. Those are the two elements from step one that we need to reflect on. As I say, in many cases it won't change, it just requires the consideration of evidence. The second step, which created a certain amount of challenge when it was first introduced, was because the unit of account under IFRS 15 is at the performance obligation level. So as it says here, at the inception of the contract, entities need to analyze the contract to identify the promises that have been made. What are the individual elements of that contract that we need to consider? Do they need to be separated out? Now, those performance obligations may be specified in the contract or they may be implied. So, for example, in the construction industry, you might get a contract which is to design, build and manage. So there's 3 elements we need to consider whether they are in fact distinct and need to be separated out. You might get in certain industries where the selling company is going to supply equipment and going to install it. So you've got 2 elements to consider there. You might get a situation in the telecoms industry with mobile phones, for example, cell phones, that actually you get a free handset. So you've got the service element, the provision of the calls, and you've got the handset. Or you might buy a new motor vehicle, and what you get is free servicing and repairs for 3 years. So you've got these different elements that have got to be broken out and identified whether or not we need to recognize the revenue for each element separately. And the focus of this splitting out, and we must split out the performance obligations when the elements are distinct. So we come back now to this, what distinct actually means. So distinct is where both of these criteria are met. So first of all, the customer can benefit from the goods or services on its own, or together with other resources. And secondly, and the most important part of the analysis, the promise to transfer the good or service to the customer is separately identifiable from other promises in the contract. So benefiting from the good or service on its own is probably fairly clear. Separately identifiable may require some thought. Now in 2016, IFRS 15 was amended slightly with a clarification to clarify this issue about separately identifiable. And they changed the way it's presented. So these factors indicate that 2 or more promises are not separately identifiable. So if they're not separately identifiable, they're not distinct. Therefore, they're not separate performance obligations. Therefore, we don't need to separate them out. We don't need to unbundle them. So we're looking at any one of these 3. So does the entity provide a significant service of integrating the goods or services with other goods or services? If it does, it's not separately identifiable. Does one or more significantly modify other goods or services? Again, if they do, they're not separately identifiable. Are the goods or services highly interdependent? If they are, they're not separately identifiable. So, for example, you might have internet services being provided. And part of the process of providing internet services is there's an activation service. In this respect, you'd say the activation service is integral to the provision of the internet service, because you can't have the internet service without the activation service. On the other hand, you might get a situation where one company is selling software to a customer, and as part of the provision of software, they offer training services. Maybe it's free, it doesn't matter, they offer training services. But in this case, the customer doesn't need to accept the training services or could obtain them from elsewhere, in which case the training services are not integral to the provision of the software. Therefore, the training services would be separately identifiable and therefore would need separating out. Or the example that many people use is in a building context, in construction contract, building a building, but actually if you look at the individual components of bricks and wood and plumbing and electrics, you can benefit from them individually, but they're all highly interdependent. What the customer is buying is a completed building, they're not buying the individual elements. So because they're highly interdependent, they're not separately identifiable, therefore each element would not be required to be separated out as a separate performance obligation. So for some industries, there will be the need to go through this process and very clearly identify whether or not they're separately identifiable. Most companies would probably want it not to be because it's easier to deal with, but whether you separate them out or not clearly has an impact on timing of revenue recognition. So step 3 is then the transaction price. So we're back up at construction level. So the transaction price is the amount of consideration an entity expects to be entitled for. It doesn't refer to fair value as IAS 18 does, the amount they expect to receive. Specifically excludes amounts collected on behalf of third parties. So this would specifically exclude things like sales taxes, like VAT, for example. But it would also deal with agents, where agents would not reflect gross revenue and costs, they would just reflect commission. So that is fairly straightforward. Now, in the guidance that IFRS 15 produces, it talks about these 5 elements that we need to consider: variable consideration, constraining elements of variable consideration, existence of a significant financing component, non-cash consideration, and consideration payable to a customer. Now, the bottom three of these are very similar to the guidance we are used to dealing with now. So if there is a significant financing component in the contract, then you discount the total revenue to present value, and the difference in present value and transaction price is recognized as interest over the term of the contract using the effective interest method. That's what we do now. That's what we carry on doing. Non-cash consideration, this might be where a customer provides a resource, maybe an asset, equipment, to the seller to complete the project. Again, as now, if the seller obtains control of the asset, then you recognize the asset and you recognize the consideration. So in simple double entry terms, that will be debit the asset on the seller's balance sheet and credit revenue. And consideration payable to customer, if the seller pays consideration, maybe as an incentive to the customer, then that would reduce revenue. But this section also deals with things like air miles and vouchers and coupons that retailers use. So reduces revenue and is recognized when we actually provide the ultimate service. So those latter three, the requirements are pretty much the same as we are used to dealing with now. Where the differences exist, where the challenges may exist, are with regard to variable consideration. So what we are required to do is, if consideration in a contract includes a variable element, entities must estimate the amount of consideration to which they will be entitled. We must estimate how much variable consideration we expect to receive. This will be an annual process, a process whenever we issue reports. Now, they identifies examples of variable consideration. Some of these terms are interchangeable. But if, for example, a seller is going to offer volume discounts, then it would have to estimate the likelihood and the impact of volume discounts. Or if they allowed customers to return goods, they'd have to estimate how much consideration they expect to receive, taking into account the likely returns. If there were incentives or bonuses for meeting targets, they'd have to estimate how much they expect to receive, or conversely, if there are penalties that might be imposed, have to estimate those. Now, in the construction industry, we're used to dealing with some of these things as incentives and claims, but this is taking it across every business. So what we're told to do is we must estimate variable consideration, and we use one of these two methods as appropriate, not which is easiest or most effective for us, it's which is the most appropriate. So the expected value approach is the sum of probability weighted amounts in a range of possible consideration amounts. So this would be used where there are a large number of possible outcomes. So if, for example, you had a contract price and the contract specified that for every day that you complete the project early, you would receive an additional sum of money. So there are a wide range of possibilities to increase the amount of money received based on when we finish it. Conversely, for every day that we deliver the project late, revenue will be reduced. So in that case, you've got a wide variety of possible outcomes. So each one would be attributed a probability, and therefore we would work out what the expected value is by multiplying the probability by the possible revenue. We would use the most likely amount when there are basically very few options. It's almost like a yes or no. So if, for example, it was a case of, if you complete this on time, you will receive a bonus, and if you don't complete it on time, you won't. So you go with a most likely amount. So each reporting date, we will update our estimates. So it requires companies to develop a process to be able to do this, because it might be different to the way that you currently address variable consideration at the moment. So we estimate what we expect to receive, what the possible outcomes are likely to be. And then, if you like, from a prudence perspective, we have this issue called constraining estimates. What it says is variable consideration that we've estimated should be included only to the extent that it is highly probable that a significant reversal in the amount of cumulative revenue recognised will not occur when the uncertainty is resolved. There's a few things in there that we have to think about very carefully. This term highly probable. We understand from IFRS what probable means. Probable means more likely than not. Highly probable is at a higher threshold. And essentially it means significantly more likely than probable. That's a judgment call. And what I always recommend to clients is that they should consider setting out specific criteria at where that threshold comes into play. And obviously agree with the auditors. But it might be that having it at that threshold rather than the probable threshold, which may be where you're at the moment, could create issues. The second issue is significant reversal. Significant reversal is a significant downward adjustment to revenue. So if you estimate that you might get a bonus, you then consider, how probable is it that we won't receive it? And therefore that could be deemed to be a significant reversal, not receiving the bonus. But it's this use of significant which runs throughout IFRS that is not defined, and we need to be clear in our own entities what we mean by significant. So we estimate what the variable consideration might be, and then we bring in this highly probable criteria to decide whether or not we should actually recognize it at the moment. So it's almost like, if you turn it around, is we recognize variable consideration when it's highly probable we will receive it. I say it's at a higher threshold, so we might delay recognition for a bit longer compared with what we do at the moment. But it's about being prudent. So that's step 3. Must estimate variable consideration, must consider to what extent we should be recognizing it. So we've done that now at the contract level. What we need to do at step 4 is, if we have separate performance obligations from step 2, we need to allocate that total transaction price, including variable consideration, and we need to allocate it to the individual performance obligations. Now, as it says there, you would normally do it on the basis of the relative standalone selling prices of each distinct good. So it's in proportion to the relative standalone selling prices. It might be that there's no observable standalone price available, in which case they say we should use estimation techniques, the adjusted market assessment approach, the expected cost plus margin approach, or residual approach. But they're all trying to get back to allocating in proportion to the significance of each element, if you like, of each distinct good or service. Clearly, if you haven't got separate performance obligations, then this doesn't happen, because the transaction price that you've worked out in stage 3, step 3, is allocated to the whole contract. So significance of performance obligation breakdown impacts upon what happens at step 4. So that takes us on to step 5, recognizing the revenue. So we now know what the total revenues for the contract. We now know how much we've allocated to each performance obligation, and we're going to recognize it for each performance obligation level, because that's the unit of account. So what step 5 says is that we recognize revenue when or as the entity satisfies an obligation by the transference of a promised good or service, an asset, to a customer. And it talks about the transference takes place when the customer obtains control of that asset. So what we've now got in IFRS 15 is a control approach rather than a risk and rewards approach, which is really what IS 18 is all about. So control is defined as the ability to direct the use of the asset and obtain substantially all of the benefits. So this is where the customer has the right to decide whether they're going to use the asset, sell the asset, or just hold the asset. If they obtain substantially all the benefits, then they have obtained control. And so what IFRS 15 then identifies is either we recognize revenue at a point in time or over time. Now, of course, what we've got at the moment in IS 18 is we have guidance about when we recognize revenue for the sale of goods or for the rendering of services. And then is IS 11, we have the recognition of revenue for construction contracts, which is over time and will probably stay the same, subject to the analysis. So what we now have is no distinction between goods and services. We just have an approach to recognizing revenue at a point in time or over time. Now, what IFRS 15 requires us to do is to consider whether we should recognize revenue over time. That's the start point. And so it gives us these three possibilities. And if we satisfy any of these possibilities, then we recognize revenue over time. So the first one is the customer simultaneously receives and consumes the benefits provided. So this would be where the customer obtains, so the seller is providing routine services, recurring services like cleaning, for example. It might also apply to project management services, where you get the benefit as you receive that service. It can also apply to a situation where if the seller stops performing under the contract, stops providing the services that have been agreed, and another entity takes over, then if the entity that takes over the contract doesn't have to re-perform what's been done so far, they merely pick up from where they've got to, that again would imply the customer is simultaneously receiving and consuming the benefits provided. The second occasion when it be over time, very important for construction, is where the entity's performance creates or enhances an asset the customer controls. So this would be a construction company building an office block, let's say, on land a customer already owns. Or it might be a construction company doing some changes to a building that they already own, a house or an office block, whatever it may be. So they're creating or enhancing an asset the customer controls throughout the process. That control approach is what we use. And the third one is the entity's performance, the seller's performance does not create an asset with an alternative use to it, and the seller has an enforceable right to payment for performance completed to date. So this, for example, would apply with audits. That if an auditor starts off an audit and then for whatever reason stops partway through, then that audit, that partially completed audit, is not an asset that the auditor can sell to another entity. They can't sell it to anybody else. So it doesn't create an asset with an alternative use. And it's likely that the auditor has an enforceable right to payment for work done to date. So an audit would be recognized, revenue would be recognized over time because it meets that third criteria. Might also come into play if the seller is developing a bespoke asset. So therefore, because it's so bespoke for a particular customer, it cannot be sold to anybody else. So again, that would mean when developing a bespoke asset, we'd recognize revenue over time. So any one of those three satisfied, recognize revenue over time, as the contract progresses. So if we're going to measure recognize revenue as the contract progresses, we need to know how. How much should we recognize each time? What percentage of total revenue should we recognize each year? Now, importantly, IFRS 15 says entities should use a method that depicts performance, that reflects, if you like, value added. So entities are not allowed a free choice. They can't use the one which is easiest or one they like. They've got to use the one that reflects value added. And they give a range. They identify them as output methods or input methods. Familiar to those of you applying IS 11 with regards to the percentage of completion basis. There's just more variety, more guidance with regards to them. But essentially, this is the percentage of completion method approach. So working on which is the most appropriate by contract, because we could use a different approach for a different contract, that would be perfectly acceptable and reasonable to do. And whichever methods we use, we will need to disclose and we'll need to justify why we've used the measure that we have done. So that's something that should be largely familiar in the provision of services and certainly in the construction industry situation. This is the guidance as is now, just for confirming the whole thing, that if an entity is unable to reasonably measure the outcome of performance obligation, i.e. we're not sure if we're going to make up profit or not, but it expects to recover costs, then we recognise revenue to the extent of costs incurred until such time as it can measure the outcome. So we're recognising revenue to equal costs, so we don't recognise profit until such time as we can demonstrate that we are expecting to make a profit. Recognising revenue at a point in time. So this is the default position. So we've considered whether we can recognise revenue over time by meeting any one of those three criteria. And if we don't, then we default to a point in time. The question is, which point in time do we default to? So what IFRS 15 does is it gives us 5 indicators of control that might indicate where the customer now has the right to direct the use of the asset and the right to substantially all the risks and rewards of ownership. And they just suggest these for you. It's not a checklist that you go through to say, yes, it's that one or the other. It's getting the sense of which one indicates that that control has passed. So it might be where the seller has the right to payment. It might be where legal title passes to the customer. It might be where physical possession passes, significant rewards, risks and rewards of ownership, or it might simply be the acceptance of the asset. So again, it might be about the evidence that we need to provide to justify the treatment that we're adopting. So that's the overview of where the key changes are coming into play with regard to IFRS 15 introduces. And as I say, I think for most companies, the change may well be limited, but as a process to go through to justify that to be the case. For other companies, we're seeing that there are some issues that are starting to make those disclosures about what the impact is likely to be. What I'd like to do is just now pick up on a few other issues very quickly that IFRS 15 introduces outside essentially the 5-step model. Looking at pre-contract costs, capitalization of pre-contract costs, loss-making contracts, presentation, and disclosure. So the costs of obtaining a contract, the words have changed and the words are important. The incremental costs of obtaining a contract are recognized as an asset if the entity expects to recover. So they must be capitalized if we expect to recover them. Now, 2 things are different here potentially. One is it refers to incremental costs. Those are the costs that an entity incurs to obtain a contract that it would not have incurred if the contract had not been obtained. So this would not include contracts associated with producing a tender, submitting a tender, because they're not linked to winning the contract. Now, this may be different, for example, to IS 11, which refers to direct costs that are recoverable, probably recoverable. So incremental costs, for example, might be limited to if when they win the contract, they will pay a commission, maybe a commission to staff or a commission to a third party. So if they don't win the contract, they don't pay a commission. If they do win it, they do. That's an incremental cost. If that was the case, that would need to be capitalized. That may be different to as it's done now. There's a certain amount of inconsistency happening now. So that's what we have to capitalize. So we have to identify the incremental costs and make sure they're capitalized and they're amortized over the term of the contract. The second issue is about loss-making contracts. The International Accounting Standards Board decided they were not going to include specific guidance with regard to loss-making contracts in IFRS 15, as was the case, or is the case at the moment. And the reason for that is that they feel there's adequate guidance in IAS 37 in reference to onerous contracts. So in terms of revenue recognition, we really have to keep a very close eye on the concept of an onerous contract. Now, an onerous contract under IAS 37, which is the provisions standard, an onerous contract is one in which contracts in which the unavoidable costs exceed the economic benefits expected to be received under the contract. So we have to look at what they mean by unavoidable costs. And unavoidable costs is the lower of the costs that would be incurred to fulfill the contract and any penalties or compensation that would need to be paid to exit the contract. Now, what's interesting is if you look at IAS 11 on loss-making contracts, is it refers to total costs and total revenue. And it may be that total costs used under IAS 11 is different to unavoidable costs under IAS 37 because of the allocation perhaps of fixed overhead. So it maybe that needs to be looked at fairly carefully. So we now need to apply IAS 37. We need to see, is it an onerous contract, by looking at the unavoidable cost issue. If it is an onerous contract, then we apply IAS 37, which means we need to recognize a provision for the present obligation associated with the contract, and therefore we need to update that estimate each and every reporting date. So we're applying IAS 37 requirements with regards to creating and updating provisions. So that's the second issue. The third issue I want to refer to is presentation. IFRS 15 introduces new terms with regards to talking about contract assets and contract liabilities, and requires us to disclose contract assets and liabilities on the balance sheet. Now, you can use alternative descriptions, so you might continue to use descriptions you currently use. For example, if you use amounts due to customers, amounts due from customers, you could continue doing those, providing it's clear. What they do in IFRS 15 is trying to distinguish between conditional and unconditional rights. So a contract asset is where you have a conditional right to consideration, but then you have a receivable, which is where you have an unconditional right. So a receivable is where you don't have to do anything else to earn the revenue. You've fulfilled all performance obligations necessary. The only thing that requires to happen is the passage of time before you actually receive the money. So effectively, it's an invoiced amount, is an unconditional amount. And so that will be presented separately and not combined with the contract asset. So we talked then about contract assets and liabilities. So a contract asset is a conditional asset because there's something other than the passage of time that needs to be done before we can receive the consideration. So there are still performance obligations to be fulfilled. I guess in simple terms, you could think of a contract asset is uninvoiced revenue, whereas a receivable is invoiced revenue. That may be a simple way of looking at it. Contract liability, as now, is if we've received consideration in advance, then we'd recognize that as a contract liability. And that's the language that you may well become more familiar with in time. The final element is just to highlight a particular issue with regard to disclosure. IFRS 15 is very clear that it sets a disclosure objective, and it's clear that it says this should be the focus of what companies actually think about including in their accounts. Must meet this disclosure objective. And so to that end, it sort of don't look at the requirements in IFRS 15 as a precise checklist. It's looking at what is necessary to meet this objective. So don't include immaterial amounts, but include more information if necessary to actually meet those objectives. It looks, when you look at the checklist, that when you look at the requirements, there are more disclosures required, and that is in essence very true. But as I say, it's a matter of what is actually required in the circumstances subject to materiality, and it may be more things are required. The driving force behind increasing the apparent level of disclosure was the dissatisfaction that users of financial statements had with the current level of disclosure, that it was sometimes difficult to understand revenue, it was sometimes difficult to understand the judgments that have actually been made. Now, what you will see if you've not studied this, and again, I can only say the devil's in the detail to go through this, is that many of the disclosures are narrative. Many of the additional disclosures are narrative, and therefore that can present quite a challenge as to how we will express this information, provide this information, rather than just being numerical. So, and one of those examples will be, of course, we'll have to think about changing the language, we'll have to think about changing accounting policies to refer to the IFRS 15 language and process that is actually necessary. So probably we will expect to see more disclosures than we currently have, and companies, entities will have to think very carefully about aggregating and disaggregating information to meet those requirements. In terms of the way the disclosures are set out, so they're qualitative and quantitative, so numerical and narrative, and they're set out under these three broad headings of disclosures in respect of contracts with customers, which might require disaggregating revenue. It might require information about performance obligations. It might require information about significant payment terms. So it might be information there that entities might not be really want to show, but they'll have to look very carefully at it. Because one of the concerns about judgments, then looking at those made in the standard, and that will be the methodologies used to measure progress, the different approaches to recognizing revenue over time, point in time where significant judgments have been made. So in addition to the IAS 1 requirements about judgments, these are very specific to do with revenue. And then if we do capitalize cost to obtain or capitalized cost to fulfill a contract, then there are movement notes and information about judgments that we've made with regards to those typical assets. So a lot to think about with regards to disclosures. So the final thing I'd like to talk about in these final few minutes is the transitional arrangements that we have to think about. We've had enough time to get ready for the principles, but it's now about timing. So as I mentioned already, the effective date is for annual periods beginning on or after the 1st of January 2018. Then IFRS 15 says that we should apply this standard either by using full retrospective application or modified retrospective. In recent standards, we've started to get these variants as being allowed as standards. The standard setters try to make it easier to comply with the standards. Let me explain the difference. So with full retrospective application, that is what we'd be familiar with over the years when a new standard comes into play. We apply the new standard retrospectively to each prior reporting period, comparative periods, and we apply IAS 8. And in so doing, we have to provide the appropriate disclosures and presentation of which line items are affected. There are a few practical expedients. Typically, they relate to contracts that have been completed, where it would be impractical to adjust the brought forward figures to then correct it going through. So when contracts have been completed, typically we don't have to do any adjustments with regards to applying IFRS 15 because it's all going to come out in the wash, if you like, anyway. All it says is we have to apply those practical expedients consistently to all such contracts and make disclosures about when they're used and the estimated impact that they might have had. So we're familiar with that concept, and that shouldn't present problems theoretically, apart from we have to sort of start at an earlier point in time. So if you're presenting 1 year comparative information and you've got a calendar year 31st December year end, then obviously you'll be starting this and doing prior period adjustments for any adjustments the 1st of January 2017, day one of the comparative, and adjusting 2017's financial statements. The modified retrospective application makes it easier because while it says that we should apply IFRS 15 retrospectively, they say the cumulative effect of initial application is recognized in retained earnings at the date of initial application. The date of initial application is the first day of the period which we first apply the standard. So if you've got a calendar year, presenting accounts, the first set of accounts affected by IFRS 15 is the 31st of December 2018. The date of initial application is the 1st of January 2018. So you would do your adjustments at the 1st of January 2018, your prior period adjustment at the 1st of January 2018, and you would not therefore restate comparatives. Again, it seems that's what most companies are going to go with because it's easier. You start later, which means therefore that your 2017 figures are not on the same basis as your 2018 figures in terms of revenue. That can work favorably. If it actually works out that under IS 18 or 11 you recognize revenue, IFRS 15 would say you shouldn't have recognized it yet. Therefore, you can actually recognize it again. So you recognize it under IS 11 or 18, do a prior period adjustment to reverse it out, and then recognize it again in 2018. So it can actually work in your favor in that respect. Clearly, it could also work the other way as well. What we should have done is we should have considered carefully which is the right impact rather than which is the easiest thing to actually do. So if we go for the modified retrospective application and don't adjust comparatives, everything goes through at 1st of January 2018 or whatever day one of your accounting period is. But IFRS 15 is only then applied to contracts that have not been completed at that date, which makes perfect sense to do that. Now, because we've got this inconsistency, therefore, between what would then be 2017 and 2018, we have to provide some disclosure. And interestingly, the disclosure in this case is you would, in the disclosure note somewhere, you have to explain how the figures that you've included in your current year, your 2018 financial statements, in my example, how they would have been affected if you would have actually applied IS 11 or IS 18 and interpretations to those figures. So effectively, you're taking the IFRS 15 figures for the current year and you're putting them back to what they would have been under the previous set of rules. So effectively, we've got to keep IS 11 and 18, whichever standards apply to you, running so that we can provide these disclosures. So it's all about showing the impact, which therefore enables us to do, or users to do, comparatives between comparative year and current year, even though the figures themselves in the primary financial statements are not the same on the same basis. The notes will enable us to make some of those judgments if we need to. And so in addition to providing the impact on the numbers, we also, as it says there on the slide, have to provide explanations for the significant changes that have been made. Now, I presume that you've already made that decision, otherwise you've got to go back a long way. So you're probably targeting this latter modified retrospective approach in line with most other businesses as well. So that brings us to the end of this webinar. I hope it's been a useful reminder of what IFRS 15 requires, and I hope that what it demonstrates is that you are ready for the requirements. I hope that you've done the dialogue with your auditors to make sure that you've got no problem conversations to develop, that you've agreed evidence that is required, which is a big part of this process. And I hope that you won't experience many changes which will cause you a lot of difficulty as you move forward. So I thank you very much for listening, and I wish you the very best of luck in applying IFRS 15 to your next set of financial statements. Thank you very much.